Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about inheritances, and we've had a lot of these questions lately, so I thought I'd fire out an email, and I'm going to break this into two categories in this video. Category one is people that are getting closer to retirement. So I'm going to call you 45, 50 plus. So, you have a good financial footing already, and all of a sudden you have an influx of cash. What do you do with it? The other category will be younger generation, 20 to 45 range. People that still have maybe kids at home, have a mortgage, have debts, have a lot of financial activity going on, or maybe you haven't even got there yet. Maybe you're in your early 20s trying to figure out how to navigate a big chunk of money. So we'll go through all of that in this video. So let's first talk about retirees or people that are getting close, 5, 10, maybe even 15 years if you're on a good financial footing, you get a inheritance. It could be from a family member, a friend, whoever it is. Doesn't really matter, but you have an influx of cash. Now in this cash, the amount that you get will obviously change what you do with it. If you get 50,000, you might go buy a new vehicle or whatever, a short-term purchase. If you get $1 million, like we've had a few clients have, then it changes the game. And 100,000, 200, that number and the impact it has on you is going to be different for every person. So I'm just going to lump everything together, but there's three key things that you should look to do when you get an inheritance. Again, whether it's $50,000 or $5 million, these are the three things you should look at if you're getting close to retire. The very first thing you should do is obviously fund your retirement. If your retirement is not already funded, this is a great opportunity to kind of lump up your money, get that moving forward for you, and maybe get an early retirement. Maybe you're 5 years from retirement, inheritance comes in and you're able to retire a bit early. So obviously that would be the best picture. But look at your RSP. If you're making a bit of money, again, in Canada, we receive inheritances tax-free. Okay, so any amount that you get will be a tax-free amount. But if you're working, especially if you're getting close to retirement, you may be in your prime earning years, making a lot of money and paying a lot of taxes. So if you have RSP room, shuffle some of that inheritance money into your RSP to write down your tax bill, get a nice tax refund, and get more money compounding for you. If you've already maxed out your TFSA, don't have room, whatever it is, look at a TFSA, make sure that's topped up as well. Then beyond that, look at non-registered investment accounts. Now, I think the next part I talk about is maybe you need some of that money. Maybe you got $500,000 inheritance, a really nice inheritance, and 100,000 kind of got you to your retirement and you're good. But the other 400,000 is not going to change your life. In fact, putting that 400,000 into a non-registered investment account is just going to be a tax liability for you, and your financial plan doesn't have you pulling it out at all. So what do you do with that? And that brings us into the second option, which is let's shuffle some of that inheritance money to the next generation. Again, I always talk about generational wealth. How do you create generational wealth? It's not by passing money from someone that dies at 85 to someone that's 65. That is not generational. If you can pass it to the 45 or even the 25-year-old, the further you can pass it down the line, the more generational wealth you're going to create. So if you're receiving inheritance, 45 plus, you get money, and you realize, I don't need all this. In fact, this money is actually going to be a tax burden for me. I don't need it. I'm not going to use it. And I'm going to put it in a non-registered investment account because my RSP and TFSA are already maxed out. And it's just going to create a tax bill. I got to pay tax on the dividends, income, interest, all that kind of stuff every single year. But I have kids, I have grandkids that could really use that money. They maybe have their own kids, they have a mortgage, they have debt. They have the financial burden that you maybe had 10, 15, 20 years ago. Wouldn't it be great to lighten that load for them a bit? And also lighten your tax bill. So if you get inheritance, put a plan together. If your plan shows you that you're going to pass that money when you're at death anyway, why not pass it now? Why not help them now? A, you're not paying that tax bill, which is great. And B, instead of them paying interest on a mortgage, they can start paying down their mortgage and build up wealth. Again, that's generational wealth. Help out your kids and grandkids. Help them, get into a house, pay off their house, anything like that. It's going to be a huge impact on them and for generations to come, because the sooner they can pay off their mortgage, the sooner they can help their kids if they have them, and it just starts snowballing. The third thing to do is kind of a hybrid between those two, and it's to buy a cottage or a vacation property that you can use with your family. So if you get inheritance, maybe you don't need the money personally, but you're not looking to pass it to your kids. Maybe your kids are already financially stable, grandkids aren't there, and it's just, we'd rather have a vacation property on the lake where we can all go to and spend time to and really pour into one another. Hey, that's great. Then look at doing something like that. Just beware that if you buy that vacation property, that cottage, at some point down the road when you die, there's going to be a tax bill if that property goes up in value. Be aware of that. So if you're trying to build like a generational vacation property, you might need to buy life insurance so that when you pass away, there's funds coming in to pay the taxes, or have enough in your personal estate to pay the taxes to keep that cottage or vacation property going. So that's just something to think about. A lot of people get into cottages and vacation properties. They buy that asset to kind of live for generations. And the reality is that when you pass away, there's a tax bill. Whoever gets it from you, when they pass away, there's another tax bill potentially. So it keeps this tax bill compounding. So make sure that you plan ahead for that tax bill. So if you're someone younger, let's say under 45, or you're in a position, you could be close to retirement, but you have a lot of debt, that kind of stuff. Maybe you haven't owned a home yet. Everyone's in a different situation, but this is really geared to kind of 45, 50 or under. And so there's 4 key things. If you're looking to get an inheritance and you're not sure what to do with it, here's the 4 things I would consider. Again, everyone's situation is a little bit different, but in general, this will probably check off the majority of you as far as what you should be doing with. So the first thing to do would be to save for a home or down payment for a home. A lot of you, the real estate market obviously has gone way up. For people that are younger, not in the market, I feel really bad for you because the market has gone up. It's driving you out of maybe where you want to live, or it's driving you into a condo versus a townhome or a home. But inheritance can change that. It can give you that down payment. It can get you into what you want to be into, and it can save you many, many years of savings. This is your golden ticket. Look at it that. Don't waste that money. Put it towards a property. The second thing I would look to do, and it could be in combination with number 1, is pay off your debts. If you have any debts, credit card debts or any other type of debt, make sure you pay those off. Like if you have a $10,000 credit card debt and you're paying 19%, and you get an inheritance of $50,000 or $100,000, if that $50,000 or $100,000 is earning you just a couple percent, pay that off. There's a huge spread in there. The other thing too is if you say, well, I'm going to take the $100,000, I need that for the down payment for my house. Most mortgage lenders will still see that debt in the background. There's a servicing factor to that. So if you're in that position where we have money, we're looking to buy a home with it as down payment, but we also have this debt in the background, go talk to your mortgage broker before you do anything. Your mortgage broker is going to tell you what the lender is going to require. Maybe you have to pay off that debt right away. Maybe you don't. Sometimes it's best to take that $100,000 for a down payment for a home, for a mortgage, and then within that mortgage, you'll roll that debt into your mortgage. So it kind of be lumped into your mortgage, but the lender might give you a bit more money, might be a better situation doing it that way versus taking $20,000 paying off the debt and only being left with $80,000. So maybe this isn't even inheritance money. Maybe this is just money that you've saved and you're not sure, should I pay off debt? Like how to kind of manage this? The person to talk to, the professional to talk to is actually a mortgage broker, because every lender, they're going to understand the intricacies of your unique situation and file and figure out what you should be doing with your cash flow as you head into a mortgage. So talk to a mortgage broker if you fall into that situation. The third thing to look at doing is topping up your TFSA, RRSP, and RESP if you have kids. Like if I got an inheritance right now, I have a home, yes, we have a mortgage, but with rates still pretty low. I got variable, as most of you know, so it's not working for me right now. But if I got an inheritance, I'd probably top up the kids' RESPs, a little bit of room left there, and then put it into a non-reg account. Everyone's situation is a little bit different. If you're not maxed out on your RRSP and your TFSAs, look to max those out. Again, if you have kids, look to use that RESP. Their 20% grant is the best return you can get, guaranteed. Government's giving you a 20% essential return through the grant on every deposit up to $2,500 per year per kid. There's limits to it. I'm not going to break that down in this video. And again, how much to put into RRSP, TFSA, talk to your financial advisor to see what the plan is best for you. It's going to be different for everyone. Maybe you get 100,000, you put 30 to your RSP, top up your TFSA the other. Maybe it's 80 to your RSP. Maybe you have a big income and you can use that tax break. So talk to your financial advisor to figure out what the best solution is for you. The fourth and final thing you can look to do is upgrade a home. And I just talked about if I got an inheritance, this is probably something I would look at doing, is just helping me upgrade the home a little bit quicker. Maybe you're in a condo and you wanted to get into a townhome or home. This is maybe your chance to do that. That lump sum is going to help you kind of upgrade that house, keep your payments the same, but just get a bigger property. Maybe you've had more kids, you just need more space, or whatever it is. When I always talk to clients and talking about upgrading a home, and even this is myself personally, I've told my wife, look, we can upgrade the home as soon as I have the cash for the upgrade. I don't like to upgrade a property unless I have the cash for the property to keep my mortgage payments the same. I like to keep my mortgage payments the same throughout. If I can afford a bigger home, that means I have the cash. That's how I do it personally. Obviously, not everyone can do that. Everyone's got their own goals and dreams and all that. For me, it's that. I save pretty hard for property upgrades. It gives you a bigger asset that can grow tax-free going forward if it's principal residence. So it can be a great solution within your overall financial plan. So I want to leave you with this. And this is what I hear from every single client that I put an estate plan together with. And it's, Jim and Sally, you guys are going to leave about, $1 million to your 2 kids or to your grandkids or to your nephews or niece. Doesn't matter who it is. Not that it matters to me, but how do you want them to kind of use that? Like in a perfect world, the feedback I always get from everyone is, I'd want to see them use it for something that helps them, helps their kids, helps their grandkids. It needs to have impact. So if you're someone getting an inheritance, like think of the person that left you the inheritance. Would they be proud of you with how you spent their money? Remember, it was their money that they left for you. The decision that you make, how you roll that out, how you use that money, would they be proud of you? If you got a $50,000 inheritance and went and bought a truck, would they be proud of you, or would they see that as a waste of money? You know, maybe you're in debt, maybe you don't own a home and you got an inheritance and you go buy a vehicle. Always think back to the person that gave you the money. They're probably leaving it to you to help you out, right? To help you get forward financially. And again, you don't have to spend the money the way that they did or the way that they valued, but you know, are you wasting their money? They worked hard for that money. They worked hard to compound it over time, to earn it originally, all of that. It wasn't just money probably that was gifted to them. And I always say, don't make your financial and retirement plan based on inheritance. We've had a few people reach out to us over the years, not in the last few years, but before that. People say, you know what, I have no money saved, but my mom's gonna pass away in the next 5 years and that's my retirement plan. And that is a terrible plan. So don't rely on inheritance, but if you get one, you could use it wisely to make a big impact for your retirement or for future generations. So thanks so much for joining us in this video. We'll see you in the next one.